After the lull of the days after the second May bank holiday, the pace just steps up a little bit this week. We have two sets of macroeconomic data which may be particularly worthy of your attention, one on each side of the Atlantic. In the UK, the big numbers to watch are the latest Purchasing Managers' Indices, or PMIs, for the construction and services industries on Monday the 4th and Tuesday the 5th of June respectively. The manufacturing indicator, well, that came out on Friday the 1st. Remember that a reading above 50 is generally indicative of growth in the industry, while one below implies a slowdown or even a downturn in activity. This chart shows the latest readings for construction and services. Manufacturing has been nestled in the mid-50s for quite some time, but construction rebounded strongly going back above 50 last month, while services also improved from a weak figure in April. Over in the USA, we got the NFIB Small Business Optimism Index, and that's due out on Tuesday the 5th of June. In April, the indicator set another all-time high of 104.8, while the number of small American firms reporting poor sales and business conditions, actually that reached a record low. So what, you might say? Well, small firms tend to be more reliant on their local economy, so if small firms are doing well, then you'd think that America, the world's biggest economy, is also doing well. In addition, small cap stocks can be a good indicator of investor appetite for risk, and when small caps are doing well, it can be a sign that overall stock market sentiment's healthy. Okay, we must all accept the past is no guarantee for the future, but it's interesting to see America's leading small cap index, the Russell 2000, set a new all-time high in May, even if that hasn't quite dragged the larger cap S&P 500 and Dow Jones Industrial Average indices to new peaks just yet. Company-wise, there isn't one single FTSE 100 firm with a scheduled announcement due this week, though there should be plenty of interesting information to be had all the same from the following corporate results and trading updates. On Tuesday the 5th of June, online electrical appliance retailer AO World and Hull-based telecoms and broadband services supplier KCOM will release full-year results. WH Smith and acquisitive plastics packaging group RPC will provide a trading statement and full-year results respectively on the 6th. And support services struggler Mighty will release its full-year numbers and give an update on its planned turnaround on the 7th. But for me, the stock most likely to cause a big fuss in the week ahead is Auto Trader, when the company publishes its full-year results on Thursday the 7th of June. Now that's partly because it's the biggest of all the firms due to update investors during the coming week, with a market capitalisation of £3.6 billion. But it's also partly because the firm is trying to hit top gear again after its cautionary comments about the availability of used cars back in March. Auto Trader is reliant on the used car market, that represents around 85% of the product on its website, and management suggested that used car stock in the year to March 2018 could be flat to down. That persuaded investors to slam on the brakes, as we can see here, although the shares have since started to regain a little bit of traction. The company stopped printing its famous magazine in 2013 and it's now purely online. It's got three key drivers of revenues, and all three will be analysed closely when the results come out, both for the year just ended and for the year just beginning. The first is stock. Management has suggested that used car transactions would fall by 1 to 3% in the year to March, and then come in broadly flat in the year to March 2019 and March 2020. Second is price. And the third is product. The key here is to look for new offerings such as dealer finance and a new search service which could drive advertising revenues. In terms of the headline numbers, consensus analysts' forecasts are looking for a 6% increase in sales to £331 million, with a further 6% expected for the year just begun, a 9% increase in pre-tax profit to £211 million, with a further 80% gain seen in the new financial year, and a 10% increase in the dividend to 5.71 pence. That equates to a yield of around 1.5%, which may not send income hunters' pulses racing, but since its 2015 flotation, the firm has increased its payout, launched share buybacks while decreasing its debt pile to £347 million, both of which suggest underlying cash flow is pretty robust. Thank you for watching, and I look forward to seeing you next time.